Welcome to The Explainer. Today, we're unpacking something that most of us literally never see, but it's this massive, invisible safety net that holds the entire modern global economy together. I'm talking about marine insurance. Think about it. Every single time you order a product from overseas, or buy a new smartphone, or even just put gas in your car, you're relying on this incredibly complex system of global shipping. And without the financial principles we're going to dive into today, honestly, none of those ships would ever even leave the port. So let's jump right in and uncover the history and the core rules that keep our whole world moving.
Let me start by throwing a question your way. What on earth does a 17th century London coffee house have to do with modern global shipping? I know, it sounds like the setup to a weird joke, but it's actually the incredible origin story of a multi-billion-dollar industry. Look, today's supply chains are, highly orchestrated and heavily regulated. But centuries ago, sending a ship across the ocean was the ultimate gamble. So let's trace exactly how we got from those ancient high-stakes bets to the structured safety nets we completely rely on today.
To find the real roots of this, we actually have to go back way further than that coffee house. The deep historical origins of marine insurance trace all the way back to the 12th and 13th centuries. It was largely pioneered by Italian and Jewish merchants. Sea trade was absolutely exploding at the time, but the financial risks of losing a ship to a sudden storm or to pirates were completely ruinous. So by the 14th century, Italian traders formalized the practice using some very specific types of maritime loans. Now, these weren't your standard everyday bank loans. These were intense financial instruments directly tied to whether or not a voyage actually survived. Okay, let's contrast two of these archaic 14th century maritime loans, Bottomry and Respondentia. Picture this, you're a ship captain, and you desperately need cash to fund a voyage. You'd take out a Bottomry bond. That's a loan secured by the vessel itself, or the vessel and the cargo. But here's the kicker. If the ship sank and the venture was lost, you didn't have to repay a dime. The lender took on all the risk of the sea. Respondentia was a really similar concept, except it was an advance secured on the cargo alone, so the merchant only repaid it if the cargo safely reached its destination. It was this crazy high-stakes system of risk transfer, but it laid the absolute groundwork for modern underwriting.
Moving on from those early Italian roots, the practice really prospered in England. By around 1720, individual underwriters, basically people who were willing to take on these shipping risks for a premium, started gathering at Edward Lloyd's Coffee House on Lombard Street in London. And it just organically became the absolute epicenter of world marine insurance. Boat owners, bankers, traders, they'd all just show up there to find people to insure their voyages. Fast forward a bit, and by 1871, this informal little coffee shop gathering was officially incorporated by an act of parliament into the Corporation of Lloyd's. They kept growing, and in 1986, they shifted into their iconic modern building. Today, Lloyd's of London is this massive global market where almost anything in the world can be insured.
But here's the question. How does a market sitting in London actually know what's happening to a ship way off the coast of South America or in a tiny port in Asia? Well, they rely on a truly fascinating global web of Lloyd's global agents. These agents act as their eyes and ears on the ground. They collect local shipping intelligence, they report casualties and movements, they arrange damage surveys if something goes wrong, and they even assist the shipmasters. And what's uniquely brilliant about this structure is that these agents aren't actually on the Lloyd's payroll. They don't get a salary. Instead, they charge fees directly for the specific local services they render. It is just an incredibly efficient way to run a global intelligence network.
Now, you might be wondering, why is this still such a huge deal today? Honestly, it boils down to this one simple reality. There is no legal requirement to insure the goods, but banks will absolutely demand it. And that right there is the engine of modern global trade. International trade is financed by banks using instruments like letters of credit. A bank is simply not going to finance a multi-million-dollar shipment of electronics unless those goods are insured against marine risks. The insurance policy basically acts as collateral security. So, sure, no international law forces you to buy marine insurance, but the reality of the banking system makes it completely mandatory if you want to play a part in global commerce.
And the scope of what's actually covered today, it is staggering. We're not just throwing some insurance on a wooden boat anymore. The scope covers the ship itself, which is known as hull and machinery. It covers the cargo inside and the freight costs, but it also extends to massive liabilities, like ship owners' liabilities for pollution or crew injuries. It covers time charterers' liabilities, builders' risks for ships that are literally still being built in the shipyard, and even multimodal entities like the truck operators moving the cargo inland. Oh, and yes, it even covers extreme modern perils, like war risks, strikes, and even kidnap and ransom. The net of protection has just grown to be incredibly vast.
To really grasp how this whole global system works locally, let's zoom in and look at India's specific regional evolution. It's a pretty wild ride, actually. It started way back in 1818 with the Oriental Life Insurance Company in Calcutta. But, it was not a smooth journey. In 1912, legislation was passed that actually discriminated against Indian companies, putting them at a massive disadvantage compared to foreign firms. That eventually led to huge pushback, culminating in the landmark 1938 Comprehensive Insurance Act. By 1938, the market had boomed to 176 companies, and this new act brought in strict state control to finally protect Indian insurance interests against foreign dominance.
Right after independence, the Indian government took a totally radical new approach. They basically rolled out a massive wave of nationalization in two distinct stages. Stage 1 hit in 1956, when life insurance was completely nationalized into the Life Insurance Corporation of India, or LIC. Imagine the sheer scale of that, absorbing over 200 separate companies and societies into one single giant entity. Then came Stage 2. In 1972 and 1973, general insurance, which includes marine, motor, and fire, was nationalized. The government set up the General Insurance Corporation of India, or GIC, and gave it the full mandate to superintend, control, and carry on the entire general insurance business across the country. So post-nationalization, all those previously private general insurance companies operating in India were scooped up and merged into just 4 massive regional subsidiaries. The entire market was divided geographically. You had National Insurance over in Calcutta, New India Assurance in Mumbai, Oriental Insurance in New Delhi, and United India Insurance down in Chennai. Now, while GIC oversaw the whole operation to control costs and manage investments, these 4 subsidiaries were actually set up as separate business entities. They were expected to be somewhat competitive with one another, operating through these really vast networks of regional and branch offices.
But, as we know, markets rarely stay static, right? India eventually made a huge pivot toward liberalization. In 1999, the IRDA Act came along and created an independent regulator. By 2000, the market was dramatically opened back up to private players. GIC was delinked from those 4 subsidiaries and transformed purely into a reinsurance, so basically an insurance company for other insurance companies. But honestly, the most pivotal game changer happened in 2007, when insurance tariffs were completely removed. Before 2007, a massive 70% of the general insurance business was dictated by fixed, prescribed tariffs. Removing them threw the doors wide open for true market competition and dynamic pricing.
Okay, so now that we've got a handle on the market structure, let's dig into the actual legal bedrock. What exactly is the law promising here? Well, the Indian Marine Insurance Act of 1963 defines a contract as an agreement whereby the insurer undertakes to indemnify the assured against marine losses. The absolute key word there is indemnify, which just means to make whole again financially. What's really fascinating is that India's 1963 Act was incredibly closely modeled on the UK's foundational 1906 Act. Why? Because London was the maritime center of the world. By copying their act, India could instantly leverage centuries of established global customs and legal judgments to resolve any disputes efficiently.
But what exactly counts as a marine loss? Well, the Act explicitly defines maritime perils, and I've got to say, it literally reads like the plot of a pirate movie. It covers fire, war, pirates, rovers, and thieves. It covers jettisons, which is when you intentionally throw cargo overboard to save a sinking ship. It even covers something called barratry. That's actual fraud or gross criminal negligence committed by the ship's master or the crew against the owner. It really brings the terrifying human and natural elements of sea travel right back into this dense legal text. The ocean is wild, and the law literally has to account for every single terrifying possibility.
Now, obviously, there are some pretty strict conditions attached to all this. The absolute most fundamental legal principle is the warranty of seaworthiness. Here's how it works. If you take out a voyage policy, which is insurance for a specific trip from point A to point B, there's an absolute, unwritten, implied warranty that the ship must be seaworthy the very moment it leaves the port. If it isn't, the insurance is completely void. However, if you buy a time policy, say insuring a ship for a full calendar year, this warranty actually isn't implied in the same way, simply because the ship might already be out at sea when the policy renews. The one big exception, of course, is if the owner knowingly sends an unseaworthy ship to sea. If they do that, the insurer is definitely not paying out. One final, hugely important principle for how things work today is the idea of mixed sea and land risks. Because let's face it, modern supply chains don't just magically end at the dock. A marine adventure under the Act isn't strictly limited to salt water. The contract can actually be extended to cover inland waters or land risks that are incidental to the sea voyage.
So if you're shipping a container of goods from a factory in Mumbai all the way to a warehouse in Chicago, the marine policy can be structured to cover the truck journey to the port, the massive ocean crossing, and the train ride to the final destination. It completely adapts to the reality of today's multimodal operations.
Which brings us right back around to where we started. If a 17th century coffeehouse hadn't sat down and formalized these crazy rules of risk, could our modern global economy even stay afloat today? We've journeyed from Italian merchants taking out desperate loans on wooden ships, all the way through the bustling coffeehouses of London, right up to the massive, liberalized, multi-modal networks we rely on today. Marine insurance is this quiet, complex engine that just absorbs the absolute chaos of the world so that global trade can thrive. So the next time you see a massive cargo ship on the horizon or receive a package from halfway across the world, remember that invisible net of risk and resilience that made its journey possible. Thanks so much for joining me on this explainer. I'll see you next time.